India wants to build big, bullet trains, expressways, green energy, massive infrastructure push that could define our economic destiny for decades to come. But here's the twist. Every shiny new bridge or power plant comes with a hidden risk, a ticking financial time bomb if projects get delayed or cost overruns spiral out of control. This is where the Reserve Bank of India's Project Finance Directions 2025 come in. It's not just a regulation, it's a master plan to clean up India's project finance mess, protect banks from bad loans, and ensure that taxpayers' money and depositors' savings are not wasted. In today's deep dive, we'll break down what's inside this powerful new directive, what makes it radically different from old guidelines, and most importantly, what this means for India's $1.4 trillion infrastructure ambitions, banks, developers, policymakers, and you as a citizen. Welcome to Economics Destination, your ultimate pit stop for intelligent, well-researched insights on policy, macro trends, and India's economic journey. Let's decode. First, the context. India has faced a chronic problem. Mega infrastructure projects keep getting delayed. According to the Ministry of Statistics 2024 report, over 350 central sector projects are delayed, with average cost overruns of over 20%. Who foots the bill for this inefficiency? Banks lend to these projects, thinking revenue will flow once the project is operational. If delays happen, repayments get stuck. Loans turn into NPAs. Banks make losses, shareholders suffer, and the economy slows down. One infamous example, power sector NPAs. Over Rs 2 lakh crore at one point, that's more than the education budget of India in some years. So, the RBI said, enough is enough. We need one single, robust, principle-based rulebook for banks, NBFCs and housing finance companies to follow when financing projects from the day the plan is made to the day it starts earning money. That's exactly what the Project Finance Directions 2025 do. The new framework works on three simple but powerful pillars. Let's break them down clearly. Pillar 1, clear phases, clear conditions. Every project must pass through three phases. 1 design phase, detailed planning, getting environmental clearances, land acquisition, basically no more half-baked approvals. 2 construction phase, the riskiest stage. Lenders must verify progress at each stage before releasing funds. 3 operational phase, when the project earns revenue and starts paying back loans. RBI mandates that minimum land must be secured before loans flow. 50% for PPP infra projects, 75% for other projects. Why? Because land disputes are India's #1 reason for project delays. Also, financial closure must be genuine, not just paper promises. This means the full capital structure, debt, equity, even grants, must be legally binding upfront. Pillar 2, strict rules for time and cost overruns. One of the most misused loopholes earlier was lenders endlessly extending the date of commencement of commercial operations, or DCCO. Developers asked for time, banks agreed, and loans never turned bad on paper. This evergreening kept NPAs hidden. Under the new rules, extensions are capped up to 3 years for infrastructure projects, up to 2 years for non-infra like commercial real estate. Cost overruns up to 10% of original project cost can be funded if there's a pre-approved standby credit facility, SBCF. If not, lenders can still fund but must charge a risk premium, more cost for the developer. In short, delays are penalized, not rewarded. Pillar 3, early stress detection and mandatory resolution. RBI introduces a new trigger, a credit event. It's broader than a loan default. Even if a developer wants an extension or more debt, it's a credit event. The moment it happens, the lender must report it to the Central Repository of Information on Large Credit, CRILC. All lenders must discuss and finalize a resolution plan quickly, within strict timelines. If the plan fails, the loan must be declared an NPA immediately. This means no more sweeping problems under the carpet. Another big move, provisioning discipline. During construction, lenders must keep aside 1.25% of the loan value. During operation, 0.4%, 1%. If DCCO is deferred, extra 0.375%, 0.5625% per quarter of delay. Plus, every lender must maintain an updated detailed project database, name of sponsor, shareholding, debt equity ratio, loan status, credit ratings. This builds a national pool of reliable project finance data, a goldmine for future supervision and policy tweaks. So, how does this impact India's economy and its stakeholders? Let's break it down clearly. For banks and NBFCs, lower future NPAs Equal sign stronger balance sheets equal sign more capacity to lend to other productive sectors. Higher upfront compliance costs but safer lending in the long run. For developers and contractors, no more casual cost underestimation. Need for realistic timelines and risk buffers. Good players benefit. Fly-by-night operators lose out. For policymakers and regulators, better project execution equal sign more timely infra delivery equal sign boost to GDP growth. Reliable data to track and tweak policies. For the Indian economy and citizens, efficient infra equal sign lower logistics costs, better urbanization, faster trade, less wastage of taxpayer money on bailouts or recapitalizing failed banks. Higher investor confidence, both domestic and global. Imagine this, if India can reduce project delays by just 20%, it could save billions. Money that can go into health, education, or renewable energy instead. So, to sum up, the RBI's Project Finance Directions 2025 are bold, detailed, and tight. A clear sign that India is serious about cleaning up its project finance sector. It aligns our system with global best practices. Critical if India wants to attract long-term infrastructure investors and hit the $5 trillion economy goal in the next few years. But like any reform, the real challenge is implementation. State-level clearances, litigation, local land acquisition hurdles must also improve. What do you think? Drop your thoughts below. Will these directions finally fix India's project loan headaches? Are banks ready to implement these tough rules? What more can the government do to ease genuine bottlenecks without diluting discipline? I read every comment, and your insights help shape future videos on this channel. If you learned something valuable today, smash that like button. Share this with your policy groups and colleagues, and subscribe to Economics Destination for more crisp, insightful, fact-based economic analysis. Until then, keep questioning, keep learning,